In this lesson, we're going to discuss expectational order flow. We're going to discuss what it is, why it's important, and how we can use it to take higher probability trades that go in line with the way the market is moving. Now, we focus primarily on intraday trading because as phantom traders, we like to stay flexible in the market. In other words, we want to open trades and close them within the same day. The combination of order flow and market structure are important factors in determining the market's general direction. The idea of expectational order flow is created when these ideas are combined to give us clear understanding of the market's general direction. The idea that if certain directional order flow is taking place and being maintained, we should expect to see it continue until something changes. Hence, expectational order flow. The premise of this is to build trade ideas that follow expectational order flow, thus trading with the trend. So if we look at this example here, you can see that expectational order flow is built around a simple idea. This idea is the foundation of the rule set in which we will follow at Phantom to trade and follow the direction of the market. If highs are failing and demand is holding, the market is bullish and demand is in control. If lows are failing and supply is holding, the market is bearish and supply is in control. So long as these ideas continue, we trade accordingly. If we start to see this fail to be true, then we are given the indication that something has changed and we can begin to consider a reversal in the market direction. So if we look at this stage just a little bit more, we can see when this high breaks, we're expecting to see price return to a level of demand. If that level of demand holds, what we expect next is price to continue moving to the upside, breaking the previous high. Now, if we look at this example, we can see that if we draw this just to make things a little bit clearer, we have a structural range of this low and this high. And once this high breaks right here, creating this high, we expect to see price return to a level of demand. That level of demand should hold if we're expecting price to continue moving to the upside. Now, the level of demand that price respects, whether the decisional or the extreme, is not overly important, but the main important thing here to note is that in order for this expectational order flow to continue, seeing this high fail and this high print, we'd want to see price come into a level of demand and then continue higher. This cycle will continue as long as price action and order flow remain bullish. And similarly, if we look at this example, we've broken this low, and if we've seen a break of a low and a new lower low form, price begins to pull back. What we're expecting to see if price is going to continue trading in this overall bearish trend is that price is going to interact with a level of supply. Again, whether it's a decisional or extreme level of supply, doesn't really matter. The main thing is that price interacts with supply, that level of supply holds, and then the expectation is for that supply to push price lower, breaking the next previous low. This cycle will continue as long as price action and order flow remain bearish. Now let's talk about trading the front leg of price. Trading the front leg of price allows us to be fluid with intraday structure and order flow. The concept is straightforward. We want to trade and follow what is being built in the moment. We will continue to consider the overall expectational order flow, but we can use the current front leg of price to trade the current price with greater confidence. The front leg concept is similar to expectational order flow. The main difference is that it's built around internal structure and internal order flow, allowing us to capitalize on intraday movements, whereas expectational order flow is a little bit more broad and focuses on swing structure and more prominent order flow that represents that swing structure. This allows us to trade with relative ease and more confirmation in both counter and pro expectational order flow situations. The key thing to note is we are only using the 4-hour time frame to develop this directional bias and trade accordingly to the front leg. The 4-hour time frame is our anchor time frame, and we should always be trading in line from it. So what we want to look at is what's happened most recently in price action. We assess internal structure and address why price is shifting in the first place, whether this is a break of internal structure, respecting levels of supply and demand, or taking internal or external range liquidity. We place emphasis on what is currently happening on the chart rather than being distracted by what has happened on the chart to the left. This way, you are focusing on what is currently happening in price rather than being too distracted on catalysts for pullbacks or other things that are going to distract you from trading in line with the market. So if we look at this example, it's very similar to what we were talking about with expectation order flow. But what we'll notice is we're seeing highs breaking and prices pulling into demand. We see another high break. If a high fails, price will return to a level of demand. If that level of demand holds, price will then break the most recent high. This confirms that demand is in control and that the market is bullish. Because highs are breaking and demand is holding, we expect that because the previous high has been broken, demand will hold and the most recent high will be broken. With all of this information in mind, this is where we'll position ourselves to look to trade long or buying inside of demand levels that are created once we're starting to see this front leg and this overall concept of expectational order flow taking place. Now, if we just flip the idea, we can see if a low fails and price returns to a level of supply, that level of supply holds, price will then break the most recent lows. This confirms that supply is in control and the market is bearish. Because lows are breaking and supply is holding, we expect that because the previous low has been broken, supply will hold and the most recent low will be broken. Again, all we're looking at is when we're seeing lows breaking, we're expecting price to return to a level of supply, whether it's a decisional level or an extreme level. From there, we'll be looking to enter short or taking sell positions within those level of supplies with the anticipation or the expectation that price will continue moving to the downside, breaking that previous lower low, forming a new lower low.